Is your brain ready to be expanded? I sure hope it is, because here comes a whole lot of knowledge. Chapter 11 focuses on responsibility accounting, which ties into the concept of decentralization, which is breaking up the business into smaller, more manageable components. The biggest benefits of this is top management is free to focus on long-term strategy. Lower level decisions are based on better information because the lower level managers have that information readily at hand and can respond quickly to customer demands and needs. Lower level managers also gain experience in decision making, and the decision making authority leads to more job satisfaction because lower level managers don't feel like they're being told what to do all the time. They feel like they have some control over their destiny. What are some disadvantages? Well, lower level managers might make decisions without seeing the big picture. They might make a decision that's in the best interest of their division but could hurt the company as a whole. Lower level managers may also lack coordination with other managers in different departments or divisions, which may make the decision making not in the best interest of the overall company. Lower level managers' objectives may not be in line with those of the overall organization, and it may be difficult to spread innovative ideas throughout the organization, because if lower level managers are responsible for their own division, they may want to make their own division look good and keep all of their good ideas to themselves. Responsibility accounting is the concept that managers are held accountable to only those items they have control over. This really ties in with that concept of segment margin that we learned in a previous chapter, where we want to hold managers only responsible for those costs that they have control over. We don't want to hold them accountable for any common costs that are not directly traceable to the division that they're managing. A responsibility center is used for any part of the organization whose manager has control over and is accountable for cost, profits, and investments. There's three types of responsibility centers. The first is a cost center, a segment whose managers have control over costs but not revenues or the investment of funds. A cost center would include components of a company like HR or accounting or IT support. All of those components are integral to the company's success, but they really only incur costs because they serve as a support function to the business. They're not selling products or goods or services. A profit center is a segment whose manager controls both costs and revenues. As you know from the Intro to Financial Accounting course, profit is revenue minus expenses. So any manager who controls both revenues and costs would be in control of a profit center. A profit center example would be like Cornerstone at Paul College. The manager of Cornerstone has control over both the revenues coming in and the costs going out for that component of the university food service. An investment center is a segment whose managers have control over costs, revenues, and investments. So investment centers are more like corporate headquarters, where they're focusing on long-term decisions and growth of the business overall, and making decisions on where they should open up new stores or new divisions of the business. So how do we determine whether a manager of an investment center is doing a good job? Well, with a cost center and a profit center, we can do variance analysis, which we just talked about, and compare the current year results to the budget to determine if management is doing well. With an investment center, if you're dealing with long-term business decisions, comparing just the current year results to the current year expenditures may not be a valid comparison, because those current year expenditures may result in profitability for several years into the future. So how are we going to hold managers of investment centers accountable? Well, the answer is to use return on investment or residual income to determine how well those investment center managers are employing the assets that they have under their control. Return on investment is net operating income over average operating assets. Net operating income is generally income before interest and taxes. We're just going to call it net operating income in our problems. And operating assets would include things like cash, accounts receivable, inventory, plant and equipment, and other productive assets. Basically, any assets that is being used in the production of income for the business. So what does this tell us? It tells us for each dollar we have invested, the amount of NOI that results. So what does that mean? Well, if we had an ROI equal to 0.20, what that would mean is for each dollar we have invested in our operating assets, we're able to generate 20 cents in operating income. Obviously, the higher this is, the better. Most companies use net book value versus the gross cost to determine their average operating assets. So if you remember, long-term assets get depreciated over time. So it's the book value, the cost of those assets, less the accumulated depreciation that's generally used to calculate operating assets. Our return on investment can be broken up into two components, margin and turnover. Margin is net operating income over sales. It tells us for every dollar we generate in sales, how much income is generated. So if we had a margin of, say, 0.10, that would mean for each dollar in sales we have, we generate 10 cents in net operating income. With turnover, it tells us how many dollars in sales we're able to generate for each dollar we have in our assets. So as an example, if turnover was 2, it would mean for each dollar we have invested in average operating assets, the company is able to develop $2 in sales. And then if we combine the margin and the turnover, that gets us to our ROI. If I write out these formulas, NOI over sales for our margin times sales over average operating assets for our turnover, if you understand any math rules, you should know that the sales cancel each other out. So then you're left with NOI over average operating assets, which is the ROI formula we started with. Why would we want to break down our ROI into these two components? So we can better control our ROI. We basically have two options. We either have to increase our overall profitability or markup, which would tie into margin, or we have to utilize our assets more efficiently to generate additional sales, which would tie into turnover. So let's look at an example of how we could potentially increase ROI. With Regal Company, they report the following information. So we have NOI, operating asset sales, and operating expenses. And then it says, what's Regal Company's ROI? Well, real fast, we could get ROI simply by taking the net operating income, which is $30,000, over the average operating assets, which is $200,000, and then we get 15%. Breaking it up into its two components, though, we should arrive at the same answer. If we calculate our margin and turnover using those numbers, we'll see that margin comes out to 6% and turnover comes out to 2.5%. So when we combine those and multiply them, we get 15%, which is the ROI that I had calculated initially. Again, why break it down? Because I could see where the 15% comes from. The 15% comes from a markup of 6%, and then the efficiency or utilization of our assets, which is the 2.5 turnover. Now let's assume Regal's manager invests in a $30,000 piece of equipment that increases sales by 35, while that increases operating expenses by 15. So our net operating income is going to go up. Let's go back to the original so you can see where these numbers are coming from. We had 30 initially. So if we're generating a piece of equipment that gives us $35,000 in sales and $15,000 in expenses, the increase in NOI is going to be $20,000. So that's where we get this 50. This would have been the 30,000 original number plus the additional income of 20,000. The average operating assets went from 200 to 230. They were originally 200, and then we're adding $30,000 piece of equipment. And then our sales went from 500 to 535 because we added an additional 35 in sales as a result of this investment. And then our operating expenses went from, I think they were 470 before, and we added another 15, bringing us up to 485. So we can calculate our new ROI. I'll do it in the shortcut way, which would be the NOI of 50,000 over the average operating assets, which are now 230. So if we do 50 divided by 230, we're going to see that our new ROI is 21.7%. Why does that exist? Well, if we break it up into its components, margin and turnover, we could see our margin went up significantly. It went up to 9.35, and our turnover went down a little bit to 2.33. I believe it was 2.5 before. And our margin was 6% before. So our margin went up significantly, and even though our turnover went down a bit, our overall return on investment increased from 15 to 21.8% as a result of this investment opportunity. So if I was a manager and I'm being held accountable for the return on investment of my division, this looks like a good opportunity because my return on investment is going to increase from 15 to 21.8%. There's some criticisms of using ROI. Management may not know how to increase ROI. We didn't talk about a balanced scorecard, but basically if we don't know the details of how to increase our return on investment, it may be difficult to do so. Managers often inherit many committed costs and they don't have control over those. So one way we can improve return on investment is to increase our net operating income. And one way we can increase net operating income is to reduce costs. Well, if we have committed costs that we can't control, it's going to make it difficult to eliminate those in order to increase our net operating income. And then managers evaluated on ROI may reject profitable investment opportunities. This one is probably the most important thing to remember, because what happens is if we have an investment opportunity that earns a return higher than the company's required minimum, we may reject it if it brings our division's ROI down. For example, if our ROI was 20% and the company accepted any opportunity above 15, if a new opportunity came across our division at 18%, we may reject it, because if we currently have a 20% ROI and we add an 18% investment to it, the average ROI at the end is going to decrease, and therefore may decrease our bonuses at the end of the year. So we may reject that investment opportunity, even though it may be in the best interest of the company overall, if the company policy is to accept any opportunity earning more than 15%. 18% is more than 15%, but it's less than the division's current 20%. And we're going to talk about a way around that, a way to make sure that the incentives of the company overall are in line with those of the investment center's managers in our next segment. So that's something to look forward to.